Hello everybody, thank you for joining us and welcome. I'm joined today by Blake Henricks, who is Firetrail's co-portfolio manager of the Australian High Conviction Fund. Blake, I'd like to jump straight into Q3 performance. Could you give us an idea of some of the key themes that you're seeing in the market?
Yeah, so at the moment there's basically three big themes out there that we're seeing. The first one is really strong performance out of the tech names and healthcare names. And what we're seeing is a real gravitation by the market towards companies that can generate their earnings growth through either industry or market share. To us, what we're seeing at the moment, though, is some of those valuations are just too rich for everything we're seeing. So they were the best performers in the quarter. The second thing we saw was that raw material inflation was something that was coming across the board. Most industrials are feeling it, particularly Australian companies. You look at the Aussie dollar oil price, it's actually almost back to near all-time highs. So when you look at that, we've seen companies that are exposed to transport, airlines, the likes of Brambles, Amcors of the world, all doing it pretty tough, to be honest, at the moment as they try and push through prices. As an investor, what we're seeing is the market's really putting all of those stocks in the same bucket and saying, well, if you've got raw material headwinds, we're going to not only take your earnings down, we're also going to derate your multiple. And that's creating the opportunity where you buy the ones with better industry structures, better market positions, and we think they'll be able to get prices through over time. The third big theme is the Royal Commission into financial services. I won't talk about that specifically, but one of the biggest things we're seeing in the market right now is the crackdown on credit. It's impacting housing prices, particularly in the key markets of Sydney and Melbourne. We're also seeing even auto sales down, so the availability of credit is shrinking. And what we do know, as we look back over a long time period, the most powerful cycle in the market is the credit cycle. So those are the big three things we're seeing right now.
Now, I'd like to drill down a little bit further into portfolio performance. Could you give us a little bit more insight into performance of the portfolio in Q3?
Yeah, sure. So it was a tough quarter for the strategy. If I talk about what contributed positively first, it was really in the oil space. Both Worley Parsons and Woodside Petroleum are two key holdings in the fund. We really like the outlook for oil. A great CEO once told me, he said, in the short term, demand will determine prices. In the long term, it's supply. And what we've seen ever since oil hit $27 in 2016, a continual upward trajectory of the oil price. And the reason for that is while demand's been running very steadily at around 1.5% per annum, the supply has been underinvested in. And if you don't invest in oil, on average, fields decline at about 6 to 7% per annum. What that means is, with 3 years of no investment, we're starting to see a big catch-up cycle in play. And so Worley Parsons and Woodside are both really well positioned as that cycle turns.
Fantastic, Blake. That's good to hear some of the contributors to the quarter. Could you just talk us through some of the detractors to portfolio performance?
Yeah, the two biggest detractors were Nufarm and Sims. And if I take Nufarm for a moment, the whole investment thesis is really built on two things. The first one is a market share opportunity in the global crop protection space. That space has been dominated by 6 players for a long time now. Those 6 players have now gone to 3. They've all merged with each other. So we've seen a really once-in-a-lifetime industry consolidation. What that means, and we've been to Europe and the US recently talking to agricultural experts, is that farmers are very concerned about market concentration and the demand for new farm services. An independent player, a smaller player, a more nimble player is going to grow, and so you've got a big market share opportunity there. The second thing is omega-3. Omega-3 is a plant-based fish feed substitute, and we're starting to move into monetisation over the next couple of years. That could be pretty material to Nufarm's earnings, and it's currently today in there at no value. And so for the market share opportunity and the omega-3, we're seeing a big opportunity there. Why it fell, though, was for 2 reasons. One was the drought. We saw really, particularly on the East Coast, 1 in 100 year drought. And as you can imagine with crop protection, if you're not planting, you're not using crops. And so in Australia, the earnings were down around 90% in that July 18 period, so a very challenging period. The second thing was glyphosate concerns. So there was a large damages awarded to a customer who was using Monsanto's Roundup product. Glyphosate is about 10% of Nufarm's gross profit contribution. We've done a lot of work in this space, and what we've found is that it is a controversial product. It's becoming more political, but everything we can see is that it is a safe product if used as per the labelling. And secondly, there is no alternative. And so if glyphosate was to be removed, it's used by about 90% of farmers globally. If it was to be removed, there will be a replacement product, and Nufarm stands to to be independent.
Yeah, Blake, we saw the Monsanto documentary come through. What's next, and has this got potential ramifications both here in Australia and for markets globally?
It's definitely impacting the valuation at the moment, and so we're seeing that in the trading multiple. But in terms of farmers and their use of herbicides, we don't see a big change there. Chemical and chemistry has replaced manual farming methods over many, many years, over probably 30 or 40 years. If you weren't to use chemicals today, we'd see global production down around 40% of agriculture, and we just can't see a situation where that is allowed to happen. So whether it's glyphosate or another herbicide, we think chemicals are here to stay in the industry.
As part of your investment strategy as fundamental investors, I understand you've recently been on a company road trip in Europe. Could you tell me a little bit more about some of the companies you met with?
Yeah. So we did a lot of work with Sims Metal Management. Sims is the world's largest scrap metal producer, and it was a detractor in the period as well. It's been hit sort of three ways, really, Sims. Turkey and US tariff wars. You've seen a Turkey economic slowdown and fears of it getting worse. And then also we've seen China really put up barriers to low quality scrap in the market. So you've got these three big macro things that have happened, and the stock fell around 30% during the period. When we step back and consider, and especially as it pertains to Turkey, even in the event of a Turkish downturn, we flex steel demand down around 15%, which is a worst case scenario we believe. Turkey's electric arc furnaces, and this really came out from our trip, are all located coastally. What that means is even if they're not sending the steel domestically, they'll be exporting it. And certainly what we've seen, very supportive data out of Sims and out of some of the port data, is that Turkey continues to buy scrap as they have been doing over many periods. So in fact, when we step back and think about Sims, despite the near-term noise, we've got a company that's net cash. It's trading on around a 12 times price to earnings ratio, and you've got both organic and inorganic opportunities ahead of it. So our conviction in Sims definitely remains.
Just carrying on from that, Blake, I'd just like to talk about any changes you've potentially made in the portfolio coming off the back of earnings season or any of the recent trips that you've done.
Yeah, so we made three big changes to the portfolio. The first one was exiting Suncorp and moving into Telstra. Telstra is one that's been on our watch list for a long time. We've done multiple investment committees in the past few months. And on the day that TPG announced they were merging with Vodafone, we felt that was quite a large catalyst for a re-rating, and we've seen actually the trough of earnings for Telstra. The pressure that TPG were bringing to bear on the industry was quite material, and we feel that's been brought out now. And so as you move from 4 players to 3 players, that's going to be really positive for Telstra and their earnings. The second big change was we took a small early position in primary healthcare. Primary healthcare runs both medical centres and is a big player in pathology. And what we've seen is the CEO's come in, Malcolm Parmenter, he's had a strategy, and really that is to reinvest in an asset base which has been underinvested for a long time period. Now it is early days, but they just recently raised capital and the market didn't like it, sold the price down to a point where we felt that even in moderate scenarios there's really good upside for investors. But as I said, it is a small early position and we'll just see how that one plays out over time. The third big change was taking a position in Link Market Services. Now Link's a company we've known very well for a long, long time now. We felt we needed to get more comfort around the funds administration business where they've recently lost clients. We got that comfort two ways. One is that CEO John McMurtry's moved into the CEO role now of funds administration. What that means is while it's a potential distraction for him as CEO, it does demonstrate the importance that Link are placing on that business, and so we see that as a really positive step. And the second thing is, while it is a negative that super balances are potentially going to be consolidated if they've been inactive for longer than 13 months with low account balance, those changes are going to mean that clients are much less likely to switch, we believe, in the short to medium term because of that. Stepping away from the near-term noise there, Europe is actually going to be around 45% of earnings contribution over the next few years, and the market's really been so focused on the Australian business and some of the challenges there, it's sold it down to a market multiple, and for such a strong business, we feel that's just too cheap.
I guess moving on from that, Q3 was a tough quarter from a performance perspective. Could you give an idea of how the portfolio is positioned at the moment and as you look out towards the end of the year?
Yeah, so we've been through every single stock over and over again. We've checked our thesis, checked it as the team approach that we do, and what we keep coming back with is that this is a very good portfolio. You know, every stock in the portfolio we have high conviction in. We're still adding new stocks. We're still out on the road very aggressively, meeting with companies, checking for new ideas. And so despite the near-term negative performance, we actually believe that the portfolio is extremely well positioned and well set up over the coming years.
Thank you very much, Blake, and thank you very much to all of you. We look forward to continuing to communicate with you, and we look forward to seeing you at our fourth quarter update. Thank you.
Thank you.